Good evening, ladies and gentlemen. I'm Lamb Trades, and today I'll be taking you through my watch list for the week of March 5th, 2021. If you're new here, this is my weekly watch list video where I show what stocks are at the top of my list to watch out for this week. Don't be shy and hit that subscribe, as I am posting content like this every single week, and I wouldn't want you to miss out. Make sure you stay to the end of the video to see what my favorite play for this week is, and if you want to keep up to date with my trades and follow along exactly what I'm following during the week, I'll leave my Discord link in the description where you can join and see exactly what trades I'm looking at every single day. I also want to invite you guys to leave any stocks you want me to chart or go over in the comments, and I'll be sure to cover it in the next video. To begin, let's go over the economic events that are going to happen this week. We get consumer spending on Monday, initial and continuous jobless claims on Thursday, and then the unemployment rate on Friday. These are key to see how the economy is doing and whether or not people are getting back into work and spending money throughout the economy. We also do have a couple of earnings this week. The earnings that I'll be watching out for are on Monday, we have Workhorse, Berkshire Hathaway, pre-market, and then in after hours, we will be watching NIO and Zoom. On Tuesday, we have Target and Fubo. And on Wednesday, we have Snow, Thursday, Costco, and Gap. One thing about earnings this week, you can search it up and take a look on exactly all the earnings. These are not all the earnings this week, but most of the earnings this week are focused on those retail stores like Target, like Costco, like Gap. We have Nordstrom this week. I'm pretty sure we have American Eagle, just those kind of stores. And you can see whether or not people are starting to spend more money at those stores. So it's really, really good to keep an eye on that just to see how people are spending their money and whether or not they're going back out. But now let's go over what we saw in the market this week. So Monday seemed like the only normal day as we kind of stayed flat. The main thing that we were watching this week, and that I pointed out last week, is that we wanted to watch the 10-year bond yield, right? And throughout the week, we can see that the market did react to these increasing bond yields, and that's why I think we had such large swings. So if we pull up the 10-year bond yield, you can see, just like the market, we had large fluctuations in price, and we ended up closing a little bit higher than where we opened on the week. All of this volatility is due to the market reacting to the fact that the SPY dividend yield is 1.47%, and with a bond yield above that, investors don't have to deal with the volatility of the market if they can get the same rate with bonds. This 1.47% was a key level on the 10-year that we wanted to watch out for. On Monday and Tuesday, we didn't see much action as we mostly chopped around, but on Tuesday, we did bounce off of this bottom support as Powell was speaking and the market was able to recover, which we can see right here. So we bounced off that bottom support and we did use it for the rest of the week. But as Powell spoke, the Fed actually said that the increase in bond yields are appropriate as it welcomes any increase in inflation expectations. It sees the COVID situation giving way to strong growth in the economy and a swift decrease in unemployment during 2021. At this point, bond yields were the highest we've seen since March, and people were getting worried. But because the Fed wasn't worried, people became more confident and didn't do much. However, Thursday was the day that we wanted to watch out for. So Tuesday and Wednesday, Jerome Powell actually spoke, and he basically saved the market both days. As we can see, going into him speaking, the market sold off and then bounced immediately, and the same thing happened on Wednesday. On Thursday, however, everything came to fruition as the Fed wasn't speaking, and as you can see on the yields, we gapped up on the bond yields, and this is not bullish for the market. If we look at SPY, we can see it did hold up overnight, but after seeing this gap up and straight green in the morning on SPY for the first 10 minutes, there was something off. Once bond yields began to continue to rise instead of selling off like they did the past 2 days, people began to panic, and as the bond yield began to grow higher than 1.46%, the sell-off in the market really picked up. So if we look at it, we gapped up on bond yields and we stayed steady in the market. But in the beginning of the week, the market was really reacting on those gap up and big moves in bond yields. And we were able to play this. When we saw a gap up on bond yields and the market continuing to gap up with it, it's obvious that once people realize the fact that bond yields have increased way over the S&P 500 dividend rate, that the market was going to begin to sell off. And we saw a move almost 3% to the downside, 10 points from the high of day on SPY, and we were able to take advantage of that. It was one of the biggest increases in bond yields over a short amount of time like this, and we hit a high of 1.61, and that's when we can see down here is the market really reacting. But once we saw a pullback, we kind of evened out until we gapped down on Friday and continued down. However, you're probably saying, well, if we continued down in bond yields on Friday, why the heck did the market not bounce and go up? Well, we can look at TLT for that, because TLT is an indicator of bonds. So when the bonds go up, the yields decrease due to people going into bonds. I know it's very confusing, but it's almost like a dividend stock. If a stock is worth $20 a share and it pays out a 10% dividend, that means that the stock is paying you $2 per every share that you own. When the stock increases or decreases, that yield changes. So let's say the stock goes to 10%. The dividend, because it's already guaranteed that you're going to get $2 for every share that you own, the dividend yield will increase because the stock price decreased. So now, instead of getting 10%, you would get 20%, because if you're holding a share worth $10 and you're guaranteed $2 for that share, you would then be getting 20% versus 10% on a $20 share. I know that's confusing, but as these bonds went up, that means people are rotating into bonds rather than staying in stocks. So that's why we saw the decrease in the yield of the bonds, not the bonds themselves, and we did end up seeing a sell-off in the market. Now, there is one thing that I would be watching out for next week, and I think we would be able to see it better if we go to /ES. Now, these are SPY futures, and they're pretty much the same exact thing. They just track the index. But if we go out to the 4-hour time frame, we can actually see that up here, we made a new high. Then we made a new low. But this week, we were able to make a lower high and a lower low. This is usually indication that we are in a downtrend, and I would like to see us break out of this downtrend and possibly create a higher low or a higher high. But for now, I do think we are in a downtrend, and the only real bullish indication that I can see is a possible head and shoulders on SPY, which we can see right here. So we would have the shoulder, that would be the head, and then we would have to come down to that 370 to 365 to complete the other shoulder, which unfortunately would still be short-term bearish. But stimulus was passed this weekend, which I think will affect the market, and we may see a push upwards. However, I do believe that it's been priced in, and it could end up turning into a sell the news event. My guess is if we gap up on Monday, we do see a sell-off after, due to the fact that we closed so bearish on Friday, and the markets have been running up on stimulus for a while now. I understand that's a lot of information to process on the S&P 500 and what's going on in the markets this week. But if you have any questions, please feel free to reach out in my Discord, and I will be sure to take you through step by step. Now, let's get into the plays that we were watching last week. The first play we were watching was Disney. On Disney, we were watching for a bounce off of this previous resistance and continuation upwards to all-time highs. I also liked the rotation aspect, as I knew rising yields would cause people to get out of more growth and into value, which we talked about last week. Disney did explode on Monday and Tuesday, running a total of 10% or 20 points to a new all-time high of $200 a share. This was a huge move, and it really paid off. I would watch for a possible retest of this bottom support now that it touched that upper resistance trend line. The next stock we were watching was UAL. On UAL, we were watching a break of this upper resistance at $49 a share, which we got a clean breakthrough on Monday with that rotation into value. We were then able to meet that 51.71 resistance that we previously touched back here, and on Wednesday, we easily broke through that, touching highs of $56 a share. And then we closed above that resistance trend line, which I think is very bullish, and I like the chances of a continuation on UAL and the travel sector as a whole over the next few weeks. And the final play we were watching was RKT, or Rocket Mortgage. We wanted to see a run-up before earnings after a bounce off of this support trend line right here. We did see a push below the support trend line, and the stock was too choppy and really unpredictable to play, so we didn't play that as a run up into earnings. However, they destroyed earnings and announced a special dividend of $1.11 per share paying out in March. This stock is a $50 stock easy and is a great long-term hold. This special dividend was a very smart play by the CEO, as 40% of the float on this stock is short, and they are being forced to pay out this dividend if they want to continue being short. For this, I believe they'll cover, and it'll give Rocket a great run going into March. If we can get a clean break of this $25 level, I think Rocket will easily hit 30 by March. I will continue investing in this stock long term, but I will also be watching for that break of 25 short term. If you guys are still watching, I would really appreciate if you could like and subscribe, as I do put a lot of work into these videos every week. And if you want to, join the Discord link in my description so you can keep up to date with all my trades. Now, let's get into the plays that we're watching this week. The first play I'll be watching this week is GDX. We've been talking about this one for a while, but I'm most likely going to be entering my position this week, as I do believe it's a great hedge for inflation, and it has touched that support level that we were watching out for. I do want to see some signs of a bounce, as I am not trying to catch a falling knife. However, with stimulus being passed this weekend and the fears of inflation, I like the chances of people rotating into commodities and stocks like this, gold, silver, increasing in value. One thing I also really like is that if we look on the 4-hour, we're directly on that support, and we've diverged about 13% from that 200 SMA. And the last time we did that, as you can see here, we came right back up, here, right back up, and many other times. So I think that the ability of us bouncing off of the support, reclaiming that 200 SMA, and if we get a strong enough rotation into commodities, there is a really good chance of us breaking through the 200 SMA, and 35, which is that resistance trend line, is right above. So I do like the chances of it breaking through that. If it can break through that, my next price target would be $39 to $40 a share, which I would be very, very happy about. But as for now, I'm just going to watch to see if we can get some upwards momentum, hopefully off of this support this week. The next stock I'll be watching out for is BFT. BFT is a SPAC merging with PaySafe, and it recently broke below that 200 SMA that it had previously used as support. It also retested that 1450 support and bounced right off. We usually see a retest off of that 200 SMA when we break below, like we did here, and after we are rejected and had enough strength to continue to bounce, I like the chances of it pushing above and continuing to the upside, or being rejected and breaking below this 1450. If we're able to break below that 1450, I think that $10 to $11 range is imminent, and we might see a pullback all the way down there with the market weakness. However, if we're able to stay above, I do like the chances of this stock retesting those all-time highs, especially if we can get some good news. I think this is a great long-term hold, and even if it breaks below, I'll continue to add in anticipation of it merging with PaySafe and becoming a great long-term growth stock. And now my final and favorite play for the week is Draftkings. Of course, I had to do it to you. I know I love this stock a little too much. However, they destroyed earnings by over $100 million, and they announced they have $1.8 billion in cash with zero debt. They raised guidance for 2021, and the best part of it all is we're nearing March. And the last time there was a March Madness tournament, only one state was live and available to bet on Draftkings. Now there are more than 10, and March Madness is one of the biggest sports events this year. Fundamentally, I would marry this stock. I love it so much, but for the technical side, it was a rough week. We really sold off on Thursday, but we were able to bounce off that 200 SMA on the 4-hour with the earnings report. This is bullish because every technical trader will now view this SMA as a hard support for Draftkings, and a close above 60 for this week is very bullish. I love the chances of this stock possibly retesting all-time highs, and if we're able to break above 65, I think we see $70 to $80 a share in the next few months. I will keep you all updated on this one, but I really like it the next few weeks going into March Madness to the upside. But that is all for this week. I would be cautious to buy the dip, as there may be more dipping in the future. The best thing to do right now is to invest long term and slowly add on to those new positions instead of going all in. Don't risk more than you're willing to lose, and click the link below for the free Discord, and I will see you all in the next video. Have a good week.